Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management. Good to be back in the studio here today, Ez, and we could not have more to talk about today. So
that's for sure.
Yeah, we got all kinds of cool stuff happening as we're speaking right now. It's almost 4 o'clock p.m. Eastern Standard Time, so we're going to be getting really live earnings reports during this podcast today from two major tech players, Microsoft and Google. So as soon as I see that information, I'll share it with everyone and kind of give my take and thoughts on it. But it's been just a busy week in general of news and information. So we kind of have 5 major broad topics here today. Hope to cover them all. If we don't get to all of them, I'm sure that it will be something that we'll address in our future either happy hours or future podcasts. But Walmart came out with some interesting information today that really affected the market, specifically Walmart shares. Obviously, we just talked about tech earnings. Natural gas prices are soaring. There's been a CHIPS Act that is getting pretty close to being completely done, passed into law.
Saw that,
which is huge news. And there was an interesting article today, interesting in the fact that it caught my attention and really made me kind of do a little bit of extra research on it, in the simple fact that Barron's came out with a headline article today talking about the potential of a food shortage in some respects here in the United States, which I don't think anybody ever thought was possible, given the fact that we make a lot of stuff right here.
Right. I mean, there was that kind of little bit of scare during the pandemic talking about a famine coming. Of course, it never materialized, but now it looks like it maybe in certain things anyway, at very specific types of foods, not across the board, but.
Right. And I'm sure we're going to have some viewer questions about some of this stuff as well.
Yeah.
So basically, this show is going to rock today with a whole bunch of information, and I'll get through it as quick as we can, but we want to make sure we cover stuff too. But actually, as we're talking here, I can't help but notice that Microsoft revenues have missed. They were looking for, at least the street was looking for, about $52.4 billion. Looks like they came in at $51.87 billion, so a pretty significant miss there. They're coming out with some more data here. Earnings per share for Microsoft also was a miss. The street was looking for $2.29 per share, and they came in reporting $2.23 per share. So we'll see what this actually does to the stock in after hours, and it'll probably have some sort of impact on other big tech players as well. But the biggest part of all of these earnings is definitely going to be the forward guidance. So the CEO is going to have a analyst call at 5:30 p.m. Eastern Standard Time today. And so far, the stock really hasn't moved that much after hours. It's down about 2% or so. But that's really where the stock's going to move, is based on how the CEO and CFO go into this earnings analyst call. Essentially, what analysts are going to be looking for is, what is your outlook over the next 3 to 6 months, getting us all the way through the rest of this year? Are there significant supply chain issues? Is there waning demand for things like PCs, et cetera, that would obviously affect their revenue forecast as well as their earnings forecast? Are they seeing any FX-related problems? That meaning, hiring people and paying them the wage that they would be able to, get. And obviously, wages have gone up this year. We've heard a lot of tech companies already come out and say, we're not going to hire as many people, or we're just going to pause for the foreseeable future on hiring additional staff. So all of those things are going to be very, very important to analysts, and that's really where the stock's going to move up or down in after-hours markets. And going into tomorrow, when the market actually opens at 9:30, it'll really have everything to do with the way that they go into that earnings analyst call and what their forward guidance is. So I'm very interested to listen and hear all that stuff. That's certainly something I'll be doing after the podcast today. So it kind of gives you guys a little insight into my life after work.
Which never ends. It's all good.
Alphabet, Google, revenues also missed, came in a little light. Earnings per share was also a miss. So not by dramatic numbers here. And I can't wait to do a little bit more digging after the show and kind of get a better sense and feel for exactly what's going on here. But it looks like Google also had a issue with their top line revenue meeting street expectations as well as their bottom line. So the question is going to be for Google, same sort of thing. What does the CEO, CFO look out for outlook-wise over the next 3 to 6 months? Are they losing any ad dollars? So revenue dollars from the ads that Google has is obviously a major part of their revenue stream. And if a global economy really, because a lot of places outside the United States are worse off than what we are from a stock market perspective. But if the global economy is having waning demand, well, one of the first things that companies will do is they'll start to cut their ad budgets, right? So Snap was a great example of that. Snap stock lost like 40% of its value in like one day because that's how they make money is through ads. Well, if I'm a CEO of, let's say, Coca-Cola, and I'm thinking that demand's going to slow down for the foreseeable future, well, guess what? I may not spend any ad money on Snap. I may kind of limit the places where I do my advertising. Now, Google is probably going to be one of the later ones that you would cut, right? Because the platform's just, I mean, it dwarfs something like a Snap.
Right. People are still searching with Google no matter what. So you think about that as far as advertising.
For sure. I mean, the stock's up. Actually, Google's up about 4% as we're talking here, even though they missed top and bottom line. It wasn't by a significant number here either. So we're talking, relatively small differences in what analysts were expecting versus what Google actually posted there. But just because the stock is up, 3 or 4% after hours trading does not mean it's going to open up in a positive manner tomorrow. It doesn't mean that they're going to have a positive performance day tomorrow.
Right.
And the same thing can be said with Microsoft. I mean, these are core holdings for pretty much everybody's portfolio. I'm not just talking about clients here at Shepherd Wealth Management. Right. I can speak for Shepherd Wealth Management clients and say that these are core holdings. But what I would also say is they're core holdings for major mutual funds. They're core holdings for a lot of index funds. They're just core holdings in general for the majority of investors out there. And the reason for that, we'll kind of get into that here in a little bit when we get to the topic I wanted to get to with Amazon, because they have their earnings coming out tomorrow after 4 o'clock as well. But to kind of finish off the story here with Walmart, so they had to lower their guidance. Actually, when they had earnings last quarter, which was based on Q1 performance, right? So they dropped their earnings in Q2, and it was all obviously based on Q1 performance. They were expecting, the CEO, Doug McMillon, said, hey, we expect low single-digit growth on Walmart shares this year, earnings per share, maybe 8-9%, something like that, which would have been well received by Wall Street investors. However, based on the announcement that they just had this morning that caused their stock to sell off 8-9% and certainly had a big impact on other retailers like Target and Amazon and some others, they basically said, hey, we have to cut all of our guidance forecasts for the remainder of the year, and we actually expect earnings per share to decline by somewhere between 10 and 12%. So it's a very short, 180 flip from Q2 to Q3, and that certainly affected Walmart shares and certainly affecting a lot of other retail types of stocks today. Macy's, Nordstrom's, Ross, TJX, all these individual companies. Again, we already talked about Amazon having a hit today as well because of that news that Walmart had. And it's justifiable. I can understand how Wall Street and investors would have that sort of what's called a knee-jerk reaction to that Walmart announcement, because if Walmart, being the largest retailer on the planet and one of the largest employers on the planet, with tons of resources, all kinds of history of being able to get through different market cycles, supply chain issues, gas price spikes, and all these other things, if they can't sort of figure it out and they don't have a good grasp on it, it's not unreasonable to think that a lot of those other problems are also going to fall into the laps of all these other retail types of companies as well.
Right.
Now, for me, kind of shifting gears here a little bit into the Amazon part of this. So Amazon, as I mentioned, is coming out with their earnings announcement tomorrow. And Barron's had a very cool, very, very cool way of evaluating Amazon. It's very similar to the way that I would go about evaluating Amazon, which is why I'm going to spend some time talking about this stuff.
Let's
here
get
today.
into it. Let's get that big data energy happening.
This one is worth putting on the readers here. So the headline for Barron's, the most recent Barron's subscription that I have, which I get weekly, here's the head title. It says, Amazon stock has gotten crushed this year. There's a case it could double or even triple from here. So why is it that these analysts kind of believe that this potentially could happen? Well, I think there's a pretty good reason for that. The stock is down 25% year to date. Their 2021 revenue is expected over $520 billion. 2023 estimated revenue over $600 billion in 1 year. Now, Amazon's difficult to value because it's not just a company that can make money in one way, right? They make money in all kinds of different ways, such as, obviously their e-commerce business, which is where most analysts tend to go about valuating Amazon stock, kind of like a retailer, which is why the stock was hit by about 4% today, at least the last time I checked. But I think a lot of people are forgetting that AWS is the majority, actually it is the majority, of their actual revenue and earnings per share. Their profit margin there is fantastic, right around 40% and growing. They also own Whole Foods, which is another part of their business. They just spent a bunch of money on MGM Holdings, right?
No
All
way.
the content.
Wow.
That was a purchase that they made in March of this year, 2022. They own Zappos. They own Twitch, Ring, Audible, Blink, Goodreads. I mean, they own so many different things. They own, actually just recently spent some money on a healthcare company. They bought One Medical, which is an owner of membership-based healthcare clinics, for $3.9 billion. That was also a recent acquisition that Amazon had. But specifically, how do analysts go about evaluating a stock like Amazon that has all these different businesses inside of the Amazon ecosystem, if you will?
Yeah.
Well, again, most people tend to look at the e-commerce part of things because that's how Amazon became Amazon, starting to sell books online. Now, Amazon didn't become one of the largest companies in the world just because people wanted to go buy more books. Right. They kind of shifted and morphed into this, technology type of company. And AWS, which is their cloud-based service, that actually represents 16% of Amazon's total sales and more than 100% of Amazon's profit, because the e-commerce side of the business is expected to lose money this year. I don't expect Amazon's earnings to be, exceptional after the bell tomorrow. I mean, maybe we'll be pleasantly surprised, but I actually think that because of the high price in oil, because of the slower consumer demand to purchase things on Amazon, because of all the inflation that we're seeing here right now, it's definitely going to have an effect on the e-commerce side of the business. However, the cloud business is by far and away, to me, the most important part of the way you would go about evaluating a company like Amazon. So with revenues close to $82 billion, that's annual revenues, right? $82 billion. AWS is one of the world's largest software service companies. It's bigger than Oracle, IBM, or SAP, and more than twice the size of Salesforce. And Salesforce is the largest so-called software as a service company. AWS is going to get a lot bigger from where we're standing here today. And it's really no wonder that Jeff Bezos, who is still the chairman of Amazon, stepped down and handed the reins over to Andy Jassy in 2021. Andy Jassy was kind of the architect of building AWS. So he's definitely an obvious person that he would tap for that. Now, the second closest competitor to AWS is Microsoft's Azure and Google's cloud business. But Amazon's ad business is also substantially, a huge part of their revenue source, which when we get the announcement here from Google relating to the conference call that they have with analysts, we'll get more information regarding the ad revenue, whether it slowed down, stabilized, or actually stayed in a growth mode for Google. That'll be a big driver for Amazon shares as well. But most analysts are trying to figure out what is the sum of the parts total for Amazon. So is it actually, fairly valued, overvalued, or undervalued? And a lot of these analysts in this Barron's report are pricing Amazon somewhere between $1.2 trillion and as much as $3 trillion. Now, the interesting part about valuing Amazon, let's say at about $1.2 trillion, well, if you look at things like Amazon Prime, Amazon Music, Twitch, and the advertising, that's probably about $500 billion, according to this analyst in the Barron's report that I'm reading. And she would also value AWS at $650 billion. So those two numbers together is about $1.15 trillion, or roughly Amazon's current market value right now. The important part about that is that does not include Amazon's e-commerce business or all these other things that we just kind of rattled off here. It doesn't include the Fire TVs, the Kindles, and all these other businesses that are inside of the Amazon ecosystem. So essentially, if you look at this analyst way of evaluating the price of Amazon shares, you're essentially getting everything outside of their ad business and AWS for free.
Yeah.
At this current price, which is the reason why the article is the headline for Barron's in this past week. It's the reason why they spent, a ton of time building out this report that they're showing us here. And it's exactly the same way that I would go about evaluating Amazon as well. You do really have to break apart, all the little pieces of it and have a valuation tied to it. And it's a very difficult thing to do, no question about it. And there's a very wide range of analyst estimates in this report, but you can literally see the reason why there's a reasonable expectation that something like a double or triple on Amazon stock price could happen based on the way that they're kind of laying all this stuff out. So it's definitely important for me to be able to share this with all of my clients. I don't think everybody that is a client of mine is a Barron's subscriber. And there's a really good chance that they would be interested in trying to figure out, well, how do you actually evaluate a company like an Amazon with all these moving parts associated with it? This, to me, is the proper way to go about doing it, but it doesn't make it the right way to do it. The market doesn't really need to care about the evaluation of Amazon in any one quarter. Really what they're going to care about is, what does Andy Jassy see from AWS? Is it still growing at the pace that it has grown? Can it sustain that? And then what about all the other parts of the business looking out 6-12 months, just like every other CEO and CFO is going to have to go through in this analyst call after they produce their earnings and share that with the public, is can we protect our margins? Well, if AWS is growing, the answer is heck yeah, even if they're losing money on e-commerce. So there's a lot to take into consideration here. It's a very cool article. It's definitely something I wanted to talk about a little bit today, but I could probably spend an entire 45 minutes just talking about this article and how they go about evaluating a company like an Amazon. So with that being said, we talked about Walmart. We've talked about technology earnings. We got Amazon coming out with earnings after the bell tomorrow. The other thing that was some pretty interesting news today is related to natural gas. So natural gas has hit its highest level since 2008. It's on pace for the best month ever as Russia cuts supply to the Europeans over there through the Nord Stream pipeline is what they're doing. So natural gas is now at roughly 66% for July.
Yeah.
Putting it on track for the best month going back to the contract's inception in 1990.
Oh, wow.
So it's pretty robust, turnaround here for natural gas. Over the past couple of weeks, it's really been hit very hard, just like all the other commodities. And the reason for that is when investors, let's say consumers across the globe, expect recessions, whether it's here in the United States or kind of a global recession, which is a big fear right now because Europe, is pretty much on the precipice of a recession. If they're not already in one, we won't know till we get more data out there specifically. But this is a huge problem because this is not something that can be solved overnight. And I don't think anybody over in Europe wants to give any more money to Russia based on everything that's happened over there in Ukraine, but it's also something that they're very dependent on from a natural gas perspective. I mean, that's how they keep their homes cool. That's how they power pretty much all their electricity. With a few exceptions, countries like France have the nuclear power plants, spread out across the state or the country. So they don't really have a lot of those same issues. But broadly speaking, most of Europe does have a major issue here. And these prices really just aren't expected to change all that much as we get closer and closer to the end of the summer. And now we're getting into winter season. Right now, people have to heat their homes. And if we have an excessively cold winter, just like if we have an excessively hot summer, well, they're going to have to be able to power things, keep themselves cool or keep themselves hot, depending on the type of environment that we're in.
Right.
It's really scary because you wouldn't think that this would be something that, really well-developed countries or even, for that matter, underdeveloped countries would really have to worry about. But the fact of the matter is what we're really learning here and what we've kind of talked about all year long on the podcast is countries are really trying to be independent on three things. One is chips. We're getting ready to talk about chips here next.
Right.
So semiconductor chips. They want to be energy independent for solar, for really anything related to powering a nation. And then the other thing is making sure that they have enough food, right? So they're agriculturally independent, which are things that when I was a, high school student, junior high school student, I would never in my wildest imagination would have thought that we would ever have to worry about something like having a food shortage here.
No, I wouldn't either, especially with, the global, how attached everyone is, how connected, the amounts of trade that we do. And there certainly seems like there's enough food to go around.
Yeah.
But, we're seeing, I can remember during the pandemic, that was a big scare was, there's a famine coming or a possible famine. And
no doubt. Actually, Barron's actually had a similar article along those lines. So this person's down in Emory, Texas, and their job, what they do for a living is they travel from farm to farm taking care of horses, and they also have a farm themselves that they also manage and run. And what they're seeing at livestock auctions this month and months prior, there have been more trailers coming into these auctions to drop off cattle for sale. They've also had record temperatures down in a state like Texas, which has produced the worst drought in more than a decade for many of these, ranchers.
Right.
Which means there's no grass for those animals to eat. None of these livestock owners want to actually get out of the business of raising cattle and being a rancher and running a farm, but the alternative cost to grass is hay. Well, the cost of hay in that area of Texas per roll, right, the big roll of hay is $220. Now, that used to be $45.
Oh, my God.
Not all that long ago. So yeah, that might mean we have lower beef prices because there's way more cattle up for sale than there is demand to, buy these cows and then, process them. That's not exactly going to dent inflation.
Well, no. And just because the beef is lower now doesn't mean there won't be less beef coming up. Especially if the farmers don't have what they need to keep making the beef.
Yeah, and that's a great kind of segue. So to kind of finish the article off along those lines, okay, so what's next for these ranchers then? Well, like President Biden and pretty much the rest of the leaders of the world, they'd like to have more of the energy that's produced in their countries be something like solar, wind,
right?
Those types of things, right? And what these ranchers are now seeing is that these solar companies are offering to either buy the land outright or lease it for like 20 or 30 years, right?
Wow.
What they do, though, is they come out to you and say, hey, as you're a rancher down in Texas, I come out to you. I can see how you would fit in perfectly down there.
Thank you.
But so they come to him and say, hey, I'd like to test out your land for potential, solar wind powering. And they say, okay, we'll test it out for a year. You keep running the ranch exactly the way that you would normally run it while they're doing all these tests. And if everything checks out, they say, great, I love to lease your land for 20 or 30 years. Well, the average price of a lot of these companies that are coming out to lease that farmland is about $800 an acre. So if you had, let's say, 640 acres, that's over $500,000 a year that these ranchers will be bringing in from leasing out their space for these big tunnels, wind tunnels.
So that test is to see if the two industries can kind of coexist, right? Like if you can do a certain amount, if not all of your ranching while we install these facilities. And as long as your ranching doesn't interfere with our equipment or our collection of this energy, which whatever that may be, then we can both coexist.
Right. Right, because you have to build the big tunnel, right? And then you also
cut down on grazing land, I'm sure.
Exactly. Now, I think the other tests too are like, okay, are we going to generate enough power here? Is there enough, wind or solar or whatever they're putting on that piece of property?
So that's a pretty sick deal. If you could take advantage of it, because not only can you then, let's say things turn around a little bit in the next 10 years and you're able to still farm some cattle, but you've also got this subsidiary of this energy lease.
Yeah, the
possibly.
So wind, which is definitely less lucrative, and that can coexist with crops. Mm-hmm. But if it's solar panels, that could basically take up the entire property, right? You cannot ranch around the big solar panels.
That's true. And in a place like Texas, where you don't already have the roof space to lease for solar, installing solar for a neighborhood in a place like, let's say, Cincinnati or Louisville isn't really an issue because you can navigate utilizing roofs, right? That's already there.
Right.
But if you want to go out in the middle of, a ranch and install a solar panel, that obviously is basically a structure that prevents sun from hitting the soil and all those things.
Yeah, I mean, they kind of,
they're working on changing that.
Well, speaking of the Midwest, they actually talk about here. So far, solar hasn't started to really move into the Midwest, which is where we live, obviously, and that's where most people would consider the soil is considered superior relative to other parts of the country like Texas or Oklahoma, where there can be a lot of droughts, pretty severe weather, that sort of thing. So it's a very interesting article, interesting in all the wrong ways. Never would have thought we would have, had this conversation here in the United States where we got to seriously be concerned and have a solution for, the independence of soil, of the ability to grow our own crops and not have to be dependent on anybody else as relates to feeding the citizens here in this country. So yeah,
I'm like you. I remember in high school, that was the last thing. I thought, we were always going to have the agriculture, no matter what was moved out of this, out of the country. What other industry? We always had the agriculture.
But here's the deal, though. So, Joe Biden, other leaders, they want, like I said, maybe 100% clean electricity, and the goal might be by 2035, let's say. However, the Energy Department says solar deployment will need to quadruple, and Land.com, a marketplace for rural real estate, says generating electricity solely from solar farms would take 13 million acres, or double that, to account for energy storage, electrical vehicle charging stations, and the necessary increase in electrical infrastructure. So there's a lot of stuff that has to be worked out as it relates to the three main things I think leaders across the world are trying to solve for, which is, again, being chip independent. Right, we passed some legislation for that, or it's likely going to be signed into law.
Yeah,
we need to be able to produce our own energy, be energy independent. That's going to take some time, right? We can't just all of a sudden just start building all these solar panels and dropping them all over the 50 states and wind tunnels and mini nuclear plants or whatever the actual plan is. Like, all that stuff takes plenty of time.
Right.
And then the last one would simply be, do we have the resources, whether it's soil, et cetera, to be able to produce our own food?
Right.
Right. And which is something we've never had an issue with, but now there's certainly some issues where, we're seeing that play out over in Europe, where Ukraine makes about 30% of all the wheat that's out there, and none of that stuff got sent out into the marketplace this year. So you can't just fill a 30% hole.
Right. Immediately.
Right? Immediately.
Yeah.
Right. That's not coming from Ohio or any of the other states to, you would be able to produce wheat from. So it's definitely interesting, to say the least. And I guess as it relates to all these different topics, I mean, I could literally do a 40-minute podcast on all of them, but I'm sure that we probably at least have some questions that have come in from some of the viewers here today, but before we even get to that, I kind of wanted to wrap up this topic. So inflation's been the major topic of concern for Wall Street, for investors, for anybody that's investing in the marketplace anywhere in the world. That's a huge problem. Seeing 40-year high inflation, the most recent inflation data numbers coming in over 9%, which means that the Fed's going to have their announcement tomorrow of increasing rates. The consensus is that the Federal Reserve Chairman Jerome Powell will increase rates by 0.75% again, just like he did last month. It's possible he could do a full 1%. I don't think too many people would blame him for doing that, given how inflation is staying persistently high and growing. But something as simple as meat, fish, poultry, eggs, cereal, dairy, I mean, all this stuff is up 15% or more year to date in cost for consumers. And these are numbers that we really have never seen. I mean, we haven't seen anything like this. I'm looking back from data going back to 2015, and I am not seeing anything close to that kind of spike in those basic goods that everybody's going to buy. I mean, that's something that is affecting consumers, which is showing up in the numbers that Walmart had. So we got to spend 15% more on dairy and cereal and meat and poultry and all this other stuff. Okay, great. I'm going to go buy that because I have to go feed my family, but that doesn't mean I'm going to go spend money on apparel or appliances or technology or all these other things that you could also purchase at a place like a Walmart or all these other retailers. That's the reason why you're seeing the stock price take a hit so dramatically just one day after that. So I just wanted to wrap that up. It's some interesting articles here by Barron's, but let's get to some questions here, Ez.
All right. Well, this one actually came in on the text line before the show, but it's from Sarah from Lebanon, Ohio, kind of in our neck of the woods.
Yeah.
A little north.
Yeah.
New to investing, why are earnings reports so important? You touched on this a little bit, but I think it's a good question.
Yeah. So earnings reports in the long run, that's what moves stock prices, right? Can corporations grow their revenue and keep costs under control and protect their profit margins, so if you're generating more revenue and your expenses aren't really changing, or if they're changing very little relative to the revenue that you're generating, that means that your profit margin is staying intact as revenue is growing, which gives you a chance to see even more bottom line earnings per share growth, right? So earnings in the long run is the most important thing as it relates to stocks actually increasing in price.
Right.
Mm-hmm. The problem that we're seeing right now is nobody cares what the earnings numbers are, top and bottom line. I mean, they care, but they don't care. And the reason for that is we're dealing with all these major issues as it relates to inflation, primarily supply chain issues as it relates to, China basically keeping most of their country locked down for the majority of this year. And we're still dealing with supply chain issues going back to the pandemic 2 years ago. That's why I say that investors don't care, because if you look at something like the University of Michigan Investor Sentiment Survey, which they do every single month, you're talking about the lowest numbers that they've ever recorded.
Yeah, we had a couple of happy hours where those came in and just macked everybody's expectations.
And it's not funny, but the truth of the matter is that earnings actually have been pretty darn good.
Right. That's why inflation, I think for some people, is so hard to understand, is that these companies are turning record profits. Why is everything getting more expensive?
It's because their revenue is growing, right? But if you cannot pass along all those higher costs as it relates to fuel to get those goods from wherever they're made to that distribution center, right? And then you have to get it from the distribution center to the actual store. That's another fuel cost. And you got to pay the truck driver, and you have to pay whatever ship that shipped it over or plane that flew it over. Now you have to pay the employees. Let's say it is a physical store. That physical store also has its own overhead, right? If you can't pass along all of those costs to consumers, even though you might be generating more revenue just in general because you increased your price, let's say by 5%, but employment wages have gone up 5.5%, right? We just talked about all these other commodity prices spiking. Even if you can get your revenue to grow by 5% by increasing the price, it does not mean that you've actually covered all the cost to get from the factory assembly line all the way to the end consumer's hands.
Right.
Revenues are great. In some instances, earnings per share has been really good. But the fact of the matter is, if that profit margin gets eroded and CEOs and CFOs can't articulate to shareholders like, hey, this is not going to last. This is a 1 quarter sort of event, and we think that we can now pass along for X, Y, and Z reason. Like, they have to actually explain what they're going to do over the next 3 to 6 months to fight all these headwinds, inflation, Fed's increasing interest rates, supply chain problems, like on and on. If they can't articulate a strategy for how they're going to do that, and if their numbers don't support that either, then you're going to have a significant drop in the price of these shares. And we've seen that across the board on all these earnings announcements. I think NVIDIA might have been the easiest example that I can give for anybody. All of their earnings announcements thus far this year have been like mic drop kind of numbers, like unbelievable revenue growth, earnings per share growth. I mean, everything that they make is for not only today, but they're basically building the future of a global economy. I mean, everything that they make is in all the right sectors, very cool products, absolutely a must-have sort of product. So the demand is going to stay there for quite a while, but nobody cared. Their revenue, their earnings per share, their profit margins, all this stuff has been intact and growing. They actually increased their guidance by like $800 million at the end of their first quarter. And that was for the full year.
Wow.
Nobody cared. The stock price went down. I think the stock's down maybe close to 50% or more from where it was trading at before January of this year. And it has everything to do with the headwinds that these CEOs and CFOs are facing. It has very little to do in the short run with what their actual earnings numbers are. But the answer to your question, Sarah,
yeah.
Earnings are super important. Take the earnings that you're seeing here with a grain of salt. And if you see shares of these types of companies continue to decline as they post really good earnings, then you're getting yourself an excellent company at a very attractive price. Because if you look at something like price to earnings ratios on all of these companies, they've come down already dramatically. The S&P 500 at the beginning of January was at a 22 price to earnings multiple. Now, as we're talking here, we're down at about 16, and 16 is the historical average of what the S&P 500's multiple is. So again, if you have companies like these companies we've kind of rattled off here today, and they're posting great numbers, they have strong leadership, the story hasn't changed for their product or service, and the stock price comes down after a good earnings report, maybe wait a day or two. Yeah. But you're looking at the opportunity that we would have given our right arm for, a year or two ago. So take it with a grain of salt, kind of have a long-term vision for these types of companies, and you got to make your investments wisely. Maybe dollar cost average into it. It's not like you got to throw it all in there at one time. Mm-hmm. We've talked about that on other podcasts as well. But that's the way that I would go about answering a simple question. I know I maybe give a more of a longer-winded answer there, but earnings truthfully are one of the most important things that every analyst pays attention to, and certainly something I pay very close attention to.
Excellent question, Sarah, and great answer, Joshua.
I try to do my best. I'm sure we got time for at least one more here. So
yeah, we do. We got one more. Kurt from Louisville actually texted in just a second ago. Says, if the food shortage is imminent, where should I look to purchase stocks that reflect solutions to this problem, i.e. vertical farming, urban ag, tech, etc.? So I think what they're asking is, instead of maybe, at least they want to try to conscientiously invest in this issue, something that's going to help the future, not just take advantage of the problem.
Yeah, I mean, that very well could be the future, right? Like vertical growing farms.
Yeah, I mean, we're seeing, we just talked about that for the show. I think there's a place in Dubai, the world's largest vertical farm.
Yeah, I mean, they're definitely doing some different things in other parts of the world that kind of solve for this, because maybe they don't have the best soil and all that sort of stuff. But
there's companies in San Fran, too, that are banging through that.
Yeah, so that very well may be the future. And I can't think of an individually publicly traded stock off the top of my head that does that one specific thing, but very well could be the future. However, what you can do is look at the space itself. Maybe a good place to start would be finding an ETF or a mutual fund that specifically invests in things like oil, natural gas, wheat, different types of commodity and agricultural companies. But some of the biggest players out there, like Bungie as an example, that's a great way to go about playing agriculture. You can even go as simple as an industrial stock like a John Deere. I don't think anybody would argue that, based on everything that's going on around the world from an agricultural standpoint, that John Deere is probably going to play a pretty significant role there, even though they don't do anything as far as growing things. Mm-hmm. Right? They just make the equipment to help those farmers and ranchers do their job more efficiently and effectively. So there could be a pretty strong headwind there. You can look at companies like Mosaic, which is a company that specializes in fertilizer, because there's a fertilizer shortage, one of the bigger players in that space. So once you've identified those type of companies, whether you pick an individual stock, you can then begin to compare it to all the other competitors in that exact same space. That's exactly what I do when I go about building a portfolio for a client after taking in all the information regarding goals, risk tolerance, time frame, like all the important stuff. And now we have to build a portfolio that will actually match those goals, needs, and objectives over the short, medium, and long term. But that's how I actually build a portfolio. I'll start with, what are the top 25 largest companies in the S&P 500? Because that's going to cover every sector of the 12 sectors of the S&P, right? So, for example, you can pull up Visa, which is one of the top 10 holdings in the S&P 500 based on its market cap weighting. Okay, well, Visa's primary competitors are going to be American Express, MasterCard, and Discover Financial Services. Now I got 4 companies that can compare side by side. They're all in the same industry. And even though they're in the same industry, their leadership has a slightly different view on how they operate the business.
Right.
For example, Discover Financial Services, they're a little bit more conservative with how they go about lending credit. They have a different type of borrower or consumer that they want to be able to provide credit card and lending services to, relative to a company like an Amex. Mm-hmm. So if they're in the same space and I can get a better multiple for something like Discover Financial Services, which I was able to do for clients, And a lot of people tend to forget about Discover Financial Services because the other three are so much bigger than they are.
Right.
Well, we got a very attractive price and a stock that did very well, even in a market that's very difficult to navigate. So that's how I go about building a portfolio: is who's the number one player in that space, and let's go find all of their competitors and see where they stack up. So that's the way that I would go about doing it, and it's worked out very well for us and our clients. So I certainly hope that helps. The last thing I'd say about that, I know that we're not specifically talking about technology, although I think that was maybe a very, very small part of the question. So if investors are looking for the ability to potentially do better than the overall market, again, keeping this in the context of a diversified portfolio, I never would tell anybody to have, all of their money or the majority of their money in any one space or any one stock or any one sector, right? However, if you want to give yourself the opportunity to do something like outperform one of the major indices, let's just pick the S&P 500 as an example, since technology is the biggest sector in the S&P. If you want to give yourself the outperform, you have to be a little bit more overweight that space.
Right.
Unless you expect technology to be the worst performing sector, which it has so far this year, then you can outperform by being underweight the space. So this is all in the context of a really well-diversified portfolio. We've talked about it ad nauseum, and we'll continue to talk about it because the two most important things investors can control is their asset allocation, right? The percentage of your money invested in stocks, bonds, and cash. We can always control that no matter what's going on in the world. And we can always control our temperament, which to me is the harder thing to do. And that is your secret weapon in volatile moments like what we're experiencing right now. Buffett said it famously: he'd hire somebody with a high level of temperament more so than somebody that had a whole bunch of fancy degrees next to their name, right? Because this is a very emotional game called investing. And those that control the temperament the best are the folks who are going to put themselves in a position to actually have a lot of consistent success. And I like quoting Buffett quite a bit. His track record speaks for itself. I saw in a recent article that the average performance for Berkshire Hathaway shareholders, meaning that Warren Buffett, Charlie Munger, running the show for over 53 years, has been like 20%, which is double the S&P 500. And he runs a concentrated portfolio. We're talking like 20, maybe 22 stocks.
Right.
On average is what he's typically holding there. So it's not as diversified as probably everyone watching this is 401k, right? I mean, there's something to that. And what he would say about diversification is good for those that don't know what they're doing. I would also say one of my favorite Buffett quotes, because we've talked a lot about a history of what bear markets look like. Well, Buffett also would famously say that the one thing that we know about human beings is they don't learn from history.
Don't learn from history, yeah.
So these are all the things that I take in to help me control temperament. And when you got all these crazy things going on, like Walmart, the largest retailer, saying, hey, we're changing our mind on the outlook of our performance this year and having a huge effect on the market. Tech earnings having a huge effect on the overall market this year since it's been the biggest laggard. Natural gas, commodity prices just spiking all over the place. And now we're getting some policy measures to fight things against chip shortages that we're experiencing right now. And now we're trying to solve for other things like how can we prevent things like a food shortage for the globe, really. I mean, not just here in the United States. That should be a problem that we never really have to deal with. So it's all coming at us fast. All this information's coming at us super fast, which is why I think it's super important that we have these podcast shows. It's why I do all the happy hour shows. It's why I send out monthly newsletters to all my clients. It's why I sit down with all my clients every single quarter, is because I know that every client, every person listening, watching to this is going to turn on the news at some point in time. And the news is doing its job, which is sharing all this headline information with you. It's probably emotionally fearful for a lot of people. Mm-hmm. But if you can remove yourself from the job of the news, which is to keep eyeballs on the screen, and actually look at what history would have to say during similar times that we've experienced in the past, and nothing's exactly the same, but history has a way of repeating itself because, again, human beings tend to not learn from history. We're all kind of done the same things for centuries. But the one thing I would say about that is if you bet against the American economy for the last 250 years, it's been a terrible bet.
Right.
So this is going to be something that we're going to have to work through. It's not going to happen overnight, and eventually we'll come out on the other side of this. So stay positive, right? There's a lot of terrible news out there in the world, but stay positive. Take all this tangible information based on what history has to say, and now you begin to deploy this with your own portfolio as far as what positioning do you want to have, what type of asset allocation, when you might want to consider rebalancing. All of those things are the reason why I do what I do and why we're doing this show. So these are great questions. It's been a jam-packed episode, as I think we're running right at the end of time.
We are. It's been banging like the Hilton in here.
But don't forget to call us, text us your questions, 513-630-2664. You can also go to our website, shepherdwm.com, and there's a whole bunch of background information on myself and the firm, as well as a link to our YouTube channel, as well as the Spotify channel, depending on how you like to consume your information, whether that's audible or visual. We'll definitely keep this going. And it's been a blast, Ez. I'm sure we'll have a lot more to talk about during our next podcast.
Oh, yeah. Also, a week from Friday, we'll be back doing the Happy Hour Lives.
Yep.
Last week, we were at Pensive Distillery on Monmouth Street in Newport, Kentucky, 720 Monmouth.
Yeah.
That was a good time. We're going back there.
Yeah, so please join us. Definitely join us. But as always, this is a lot of fun for me to do. Certainly hope you all got something out of it, and look forward to doing this again in just a couple of weeks. Hope you all have a great rest of your day.